and learned anything through my 11 years in banking and 3 or 4 years before that in real estate and going through the homeownership process is that things have changed and evolved over the last 10 years or so, uh, uh, for the better part of the process being uh, very much one that ensures that consumers that are wanting to embark that journey of becoming a homeowner, they have the best advantage and resources out there in regards to terms, the type of loans that are out there with uh, low rates, and most importantly of all is that they're not high risk types of loans uh, you would be pursuing for your purchase or the type of activity that you're doing. With that said, there's a lot of red tape, meaning if you're wanting to embark in that journey, we say it's very important to prepare even before you're thinking about kind of jumping into that process, just because there's a lot of underwriting guidelines that take into place, and a little bit of what we'll talk over today. It'll talk through preparation, and it talks a bit about the savings and budgeting component, a little bit about credit, and then lastly we'll go over the home ownership piece per se, and kind of how the pre-approval and some of the financing uh, pieces and intricacies work. And I think that will allow you that if you're moving into a home ownership process stage, we call it kind of having a squeaky clean profile that allows you to navigate much smoother through that process. So with that, I'll pause for a second here, make sure we have the right resources available here for us, and we'll kick off here. So we'll kick off with a bit of a budget breakdown. I think it's very important to make sure that we're understanding what all of our finances look like, and that we have a good process in place to make sure that number one, we're saving efficiently, but then number two, not only for that purchase but beyond as well. As when you look at qualifying for a home, you guys might be familiar with some of these phrases: a down payment, closing costs, but there's a couple other factors that they look at, and that is reserve funds. So whenever they look at you purchasing a home, they don't just look at you having that down payment and then the closing costs, but they also ask for you to make sure that you have, in some cases, up to 6 months of reserves to be able to pay that mortgage that you're acquiring. Okay, so it is very important to make sure that taking care of that purchase, but then life beyond that initial purchase, right? And it starts with ensuring that we have a very well structured budget in place. And funny enough, when we talk about a budget, many folks say, no, I don't like the budget. And at times it's, why don't we like the budget? We feel like it might say no to us a lot, right? You cannot buy this, you cannot buy that. I say and challenge all of us to maybe think a little bit different and say, hey, a budget doesn't necessarily tell me no, but it helps me prioritize purchases or behaviors that I'm engaging in from a financial perspective, to make sure that I am truly accomplishing the goals that really mean a lot to me, my family, etc. So kind of in helping everyone kind of get comfortable with a budget, kind of breaking down those elements. I'm breaking it down into three areas: income, expenses, and then the last piece, very important, the savings component. And when you think about savings, including all of the savings pieces that are out there, your checking account, your savings, your retirement, your 403b for you guys, and any college savings funds that are out there, etc., as they will be helpful throughout the process. Okay, then kind of taking a bit of a deep dive, into this. It's where is my money coming from, right? That's an easy one. Here are a couple of examples. Whether it is my salary, keeping into account for us looking at our pay stubs, your W-2s at the end of the year, or as you're filing your taxes. Then also we might consider any sort of bonuses, whether it is for you guys, your spouses at home, etc. Any sort of investment income that might be out there. And then child support or any sort of income. We'll account all of that, as all of those pieces are taken into consideration when qualifying for a loan, right? And then we look at the other side of the coin, which is expenses, and then some ways to identify those a bit easier, like the big ticket items that are reoccurring payments, maybe subscription or contracts that we've signed for a couple of years, etc., are a bit easier to identify than those variable expenses. We'll dive into that here, right? And we said we don't need to capture every expense that's out there, so don't go crazy trying to find 100% of the expenses that are out there. A lot of them vary month over month, right? But I think if we can look at a time frame of a month to 3 months and try to identify at least somewhere around 75%, some of the expenses, and we can find some visibility around it, that'll get us a whirlwind ahead in being able to manage that budget for ourselves, right? So look at anywhere from 2 to 3 months around it. Typically, when you look at qualifying for a home, they'll look at 3 to 6 months of bank statements. They're not going to look at your expenses, but they mainly want to see our funds sitting in an account. How long have those funds been sitting there, and then also where they came from, right? So you want to be able to have easy access to your bank statements, history, and then savings accounts, and then where all of that money is sitting. Okay. The benefit of building a budget in today's climate is that most of our expenses are done through our debit card or our online banking, etc. So we can account for, in some cases, 90% of our expenses, unless you're taking some cash out, and you can maybe think through where you spend a bit of that money on the cash side. But nowadays, with online banking and some tools that are out there, it is much easier to identify where we've been spending some of our money, and then put in place what we call the realignment piece around where we're spending our money and where we really want to place those funds at. Okay. So kind of a busy screen here, right? But I try to put a few of the different resources that we found are most helpful when building a budget. Here on the top left-hand side is what we call our empowerment plan with Fifth Third Bank offers, and all of these items we can send as a takeaway for you guys to gain access to. This is a simple PDF document, a one-pager, for those folks who maybe are not as comfortable with something like a spreadsheet, which is also helpful. And we have this resource for you guys to build. And then we also have did a little bit of research for all of us here. And there are some great online budgeting tools which actually connect with your checking accounts. You can integrate those, and in some cases allocate where you want your budget to sit, or what dollars you want to spend into the different expense areas. So whether it was mortgage, groceries, lunches, clothing, or entertainment, electronically you can set those parameters. And then throughout the month, as you just go about your way on a monthly basis, these online trackers will monitor your expenses. So, if let's say next week, middle of the month, you said you were only going to spend dining out or out lunches, some $200. And at the 15th of the month, you're already sitting at 150. Okay. The system might create somewhat of a flag. You can set up some sort of a reminder or note or alert that'll tell you, Anthony, it's the 15th of the month, and now you're already at 75% of your budget. So just some self-awareness around if I want to stay within the budget I set originally to hit my savings targets, then I probably need to change my behavior over the next 2 weeks towards the end of the month. So I'm hitting that savings target, right? So these are some good tools that are interactive, call it that, right? And then here, this is a bit more basic where if you don't want to dive into a full blown month over month budget, this is a great tool that you could do yourself. Again, having your bank statement sitting on your computer and then having this form sitting on your table with a pen and paper, okay, and fill out kind of where you've been spending, what targets you want to hit. And then probably this is a good exercise where if you did not want to do that month over month, it would be a good activity to do at the bare minimum once, and then maybe once every 2 months or every quarter, just so that you can get a good assessment. So this is a great a starter tool to do that. And again, we'll send that as a takeaway. And then this one here, again, it's a bit more involved, more manual, as you need to enter everything on there month over month. And this is, again, kind of keeping up with the theme of enhancing tools through technology. This is a very engaging tool. So a couple of great resources for you guys to take advantage of, okay? And again, as the process looks, as we set some targets that we want to hit and we identify where we've been spending our money, you guys generally are going to find a gap that we want to optimize towards. And, I say don't freak out. Maybe as you run one of these exercises, you find that you could optimize your savings budget by $500 a month. And we don't expect to find those all of $500 a month month one. It might be that month one you optimize $100 to $200, and I'll take that as a win, okay? Because now we're creating some progression and growth within our savings and changing a bit of our behavior. And that's good. It might take 3 to 4 months to optimize our budget to that number that we found we could get to ideally, okay? Here, it's a bit of what we call a guide, and this is the 50-30-20 rule. And this aligns very well with what we'll see a little bit later around guidelines when it comes to debt to income ratios. So 50% needs when you look at your overall monthly expenses, we say 50% should be allocated towards your needs. Okay, so think about housing, any sort of loans that are reported to credit bureaus, like an auto loan, student loan, potentially even credit cards, etc. And then some other things like we see on here. In your case, it might be utilities, transportation, food, and insurance. And we say, as a best case scenario guide, that should not exceed more than 50%. What we'll see later is that as you look to qualify for a loan, lenders don't want your expenses related to credit to be any more than 40 to 45% at the highest, okay? And I'll show you guys an example around that. So this aligns well. If we can fit most of our monthly needs when it comes to expenses under 50%, we will be good to qualify for most loans that we look out there, and it'll also help us maximize our budget so we can hit a big part of what we want to make sure we promote. It's paying yourself first, and that's hitting that 20% savings bucket. Statistics show that most Americans at retirement age can survive with at least 80% of their working income. So think about how much money you're making today working. And if you were to retire tomorrow, statistics show that you should live with somewhere around 80% of your income. You're maybe spending less money out, you're traveling less, spending less money on gas, etc. Right? Other expenses, maybe buying less clothing, etc., dress up, and so forth. So we could potentially survive with 80% of our income in expenses, okay? And again, that 20%, an optimal number, we might say, Anthony, I'm not at that number. That money's not sitting in my savings account. So remember, it doesn't need to be all sitting in your savings account. We can use all of the savings vehicles that are available to us. Example, checking, savings account, an IRA, your 403b offered through your employer, etc., and those numbers of pieces. So it might be that it's 6% being contributed for your 403b, another 2 to 3% into an IRA, and then the rest of that, it's 7 to 8% sitting in your savings or your checking account that you're necessarily not using or ideally, right? And if at some point you look at some of those pieces and you say, Anthony, I'm sitting at 6% savings, then certainly that's we'll gradually try to increase that number of savings somewhere close to that 20% mark, all right? And then lastly is the 30% of wants, right? And sometimes the needs and the wants tend to get a little bit blurry. But then again, kind of, if that's why it's important to identify goals, right? So identify the goals that you want to hit. So as we kind of come into any sort of wants, then we can decide and wage out if that's something that I need to do now, or maybe I could put off to a little bit later. When it comes to budgets as well, a lot of savings are found on behavioral spending. That's why we talk, a lot about the wants versus needs component, and then leveraging these sorts of budgeting tools out there. Again, to create some self-awareness around behavioral spending, which we can find a lot of money there when we run these exercises one-on-one with folks. But then also don't overlook your contracted expenses. So, whether it is your, Netflix of the world, whether it is your subscriptions, whether it is your, Pandora, Spotify, or any of those things that are out there. But then also look at some of the larger pieces, like any sort of loans that you might have out there. And then an opportunity to refinance those, especially if you are an active credit user and you have outstanding loans and credits out there. Please, revisit the opportunity to lower the interest rate, as it can also help lower the payments and free up dollars that on a monthly basis that we can then use towards your mortgage. All right. And then the same thing on insurances, right? So ask for some sort of a premium review. There are some insurance providers out there are famous for, we can save you 15% or more on car insurance or whatnot, right? As a statistic, insurance premiums can go up somewhere between 3 to 5% on an annual basis, depending on what's happened within your insurance or risk profile. If you've been with the same insurance or even cell phone carrier for 3 years or more, probably your premiums increased 10 to 15% from when you first signed up. So there might be an opportunity to again, revisit what your premiums are and see if there's a better provider out there that can help free up some dollars for you. Okay, so think about your subscription payments. Do a little bit of a deep dive on any sort of reoccurring payments that are sitting out there. And you'll be surprised, if maybe there's an opportunity to free up anywhere from, $10 to $50 a month on eliminating any subscriptions that you're not necessarily taking advantage of. Okay. We'll wrap up. That was kind of the basic piece around the budgeting component. And I'm checking my time here. I think we're good on time. And then we'll dive into the credit score component, which is a big part as we move on into the progression of home ownership here. And I'll start out with this. There's two types of credit: revolving and installment. Think about revolving lines of credit as your credit cards, home equity lines, and simply these are lines of credit that they say, Anthony, you have $10,000 available for your expenditure, and I might have a credit card, right? I might have a piece of plastic in my wallet, and that's going to measure my behavioral spending. It's always available to me, and they're going to measure how I manage my everyday expenses, how I pay it back, do I keep balances high, etc., or do I not? And then installment loans, typically we ask for some sort of lump sum amount. We sign a contract, and then we say we're going to pay that in a period of 4 to 8 years, right? Auto loans, student loans, mortgage loan, etc. And that kind of rates us on the ability to repay back a loan. So again, the big piece is these two different types of credits offer different types of information, how we spend and how we pay back. And the reason in highlighting that it's we're going to see some components of those two that really impact our credit score. Okay. And I always ask, do you know your numbers? And we should, not only because, peace of mind and so forth, feel good about our score, the ability to, save some money, the ability to call it strike while the iron is hot whenever there's a big ticket item purchase. If there is an emergency that we can leverage our good credit score to get the best type of terms possible. Okay. But also, knowing your numbers and gaining access to your credit history, it's also the number one way for you to identify if you've ever been a victim of fraud. Okay. Your credit score, your credit history will give you information around that. And if you don't know your credit score, okay, these are the three different credit bureaus, okay, that in reality give us a grade on how we spend on our finances that then impact our credit score. Okay. So these are the three credit bureaus, and that's important, especially as we look at the homeownership process, that we see all three credit scores and all three credit bureaus, and that will be taken into account. Okay. If you look at services like a Credit Karma, maybe your credit card provider might offer one of the credit bureaus at no cost. You don't have access to all three, or you might have access to score or have access to history. Okay. You need access to both, as a smart consumer, protecting yourself. But then also, as you're becoming an active credit user, you need to look at all three credit bureaus and again, score and history. All right. And if you, a big question is, right? So, Anthony, I've heard that if I submit a credit inquiry, it will lower my score. So, how can I look at my score? Well, there's different types of programs out there and services that you can take advantage of in order to gain access to your credit report without it having a negative impact to your score. So, again, Credit Karma might have like a basic free membership. There might be an upgraded one that they offer that gives you access to all of that information. But also, every consumer, it's allowed to have access to free annual credit report, okay, that you can gain access to. So you can visit each of these websites. So Experian, Equifax, and TransUnion each have their own website, which you can go to and request a free annual credit report from each of those. Okay. They don't give you your score. They give you your report. Okay. So again, if you don't want to use anything like Karma, sign up for a subscription. At the very least, you can gain access to your free annual credit report. So I mentioned there are some subscription programs that are out there, and I wanted to kind of show you a bit of a glimpse of what one of these programs look like. At Fifth Third Bank, we have what we call Fifth Third Identity Alert. This would probably be very similar to what premium subscription through Credit Karma might look like. In addition to Credit Karma, this program works in combination similar to what a LifeLock program would do, which LifeLock offers identity theft insurance and protection. And simply on the credit component, it helps monitor. This is a sample of a credit profile that was looked at, and it tracks your progression on your credit score as different sorts of life events take place. And again, you can pull probably a one credit report each month, and again, doesn't have a negative impact to your score either. So why is that important? This is how you guys are being graded. So when it looks to credit, these are the components that credit bureaus look at to judge us or rate us, to give us a grading score. So here is about 10% it's a new credit. We'll dive into what that is. The credit mix, which is really using both types of credit that I mentioned, revolving and installment. Length of credit history, 15% of your score. Payment history, 35%, which is a big component of your credit score, your payment history. And then lastly, 30%, it's another big chunk there, is depth and availability of credit. And then we'll dive into that one so we can walk you through you guys to that. New credit, be wary of again, if you go to a department store and they ask you, hey, would you like 20% discount for applying for a credit card? It's not that those credit cards are bad, but if you are signing up or running your credit for a 20% discount every time you're being offered, that has a negative impact in your score, okay? I mean, I have a department store card that I signed up at this point, I think probably 15 years ago, okay? And it sounded like a great opportunity to start building credit. But every time I'm offered, I say, no, thank you. Appreciate it. Thanks. So be mindful of that. Same thing, space out your different types of credit card applications. Credit cards are a big one is if you're going out to purchase a vehicle, okay? If you're going out to purchase a vehicle, don't let just the first dealership you go to run your credit. Trust me, they will convince you to run your credit. And what's going to happen is you're going to be stuck trying to or having to buy a car there. If you don't, and if you continue to go to each different dealership and apply for credit, you need to make that purchase happen within a 10 to 14 day window, okay? If you go shopping and running your credit through different dealerships within a month, or let's say, hey, I'm going to go shopping every weekend. If a month goes by and you still haven't found that car, or at the 30-day time frame, you find the right car, at this point, your score went from the 14-day period to the 30-day period. It really probably decreased a whole lot. So the best recommendation is if you're shopping around as a smart shopper, please make sure you make that acquisition or purchase happen within a 14-day time frame, and all of those credit applications will be combined into one or a couple of applications to minimize the impact of your score. All right. Credit mix, I talked about the importance of having the different types of credit. If you have someone with just credit cards or someone with just installment loans, it doesn't give us the mix of information, again, from the behavioral spending that credit cards give us, and then the information around repayment back of a contracted loan, okay? So someone with both types of credit ultimately would have a score. So often I say, Anthony, what can I do to increase my credit score? If all you have is credit cards, if there's a sort of loan that comes into the mix, now don't just go get a loan just to increase your score. If you need one, then go get one. If you don't need one, then don't get one. With that said, ensure that there's a healthy mix, and that's where potentially you see scores of 750, 800, etc., and kind of having that healthy mix of length of credit history. I mentioned I have a credit card, department store credit card that I've had for, I think, 15 years or so now. I would never close that credit card. If I were to close out that credit card, in my case here, I would lose 15 years of credit history. It will still show up on my credit, right? But it's no longer an active trade line, okay? And that could pose a negative impact to my score. So look at this example of someone who has, similar types of loan, a 15, 8-year, 4-year credit card or lines of credit, average credit life, 9 years. Now in this scenario, similar credit profile, they've added a few other newer lines of credit, right? So it impacts on length of credit history and new credit. Their average life of credit is 5.4. These newer credit lines add a bit of a risk factor when it comes to your credit profile. So typically your score will drop a bit for it being fairly new, not having length in credit history, and then kind of a risk factor on how you're going to manage those lines of credit, okay? So again, be mindful of, keeping those long active lines of credit. And this often happens is, my credit card balances are high. As soon as I pay it down, I'm going to close it. I say, don't close it just yet. Okay, make sure that you have other lines of credit that balance out the age of your credit history, and then one other component here, which is the debt to limit ratio. Okay, and again, this impacts 30% of your credit score. All right, so take a look at this example here where there's this particular MasterCard, it's at zero balance, right? This individual's using 32% of their available credit, all right? In this particular scenario, look at it from the perspective where they closed it. It was maxed out, they closed it, right? Or the scenario where they maxed it out and there's no available credit. Now, in this scenario, they're using 65% of their available credit, all right? An optimal number of utilization. It's not necessarily based on the dollar amount, okay? It's mainly looked at the percentage of use. So again, it could be a $300 credit card. And even though you could pay it off with a couple days of work or a day of work, it doesn't matter the dollar amount. They feel like we should understand that they're grading us on percentage use. And if you're using more than 50% of your available credit, they might say, Anthony, there must be something wrong in Anthony's personal finances because Anthony's using more than 50% of his available credit. It's not that Anthony's using it for rewards, for cash back. It's because he's in financial hardship. Okay. Now, some folks might say, well, Anthony, I use them for rewards, etc. And I have a couple credit cards that I use for rewards as well that give me, fly points, etc., or something along those lines. What I would say, and this is one that this is probably the easiest way to impact your score. So if you know you're doing something related to credit in the next 30 to 45 days, and if let's say you're using 2,500 of your 30 or your 3,000 available credit, just simply dwindle down the usage and the balance on that particular credit card. And again, you could see your score go up anywhere from 15 to 30 points. Again, allowing you that as you go into that credit increase, your score is at its optimal potential out there. Okay. So again, this is kind of a tricky one sometimes. So if there's any questions, we'll go over those towards the end here. Then we'll kind of go back a bit to those subscription services that help you monitor your credit. They also provide you advising. So here's kind of a scenario that I ran on one of these. So if I think this is a newer credit card, and if I was just to continue making the payment sometime for the next 5 months, because it was a newer line of credit in this example, we could see that score potentially go up by 21 points by simply just making the payment. So this is the scenario of new credit impacts. It creates uncertainty on how you're going to manage it. So again, you might see your score drop a bit, but then as you're making the payments over the next couple of months, you will see your score increase on its own. Then lastly, the 35% of your score, payment history. This kind of relates to having negative history sitting in your credit, whether it is collections, medical bills, and whatnot. At times there's no quick fixes because it really kind of hones in on a 2-year, 24-month history of your payments, etc. That's why it's important to also keep your cards open. Let's say if there was a late payment I had last month, right? That's going to stay on my credit report for 24 months. So that's going to hurt my score. But if I close the credit card, that history is going to stay there. Okay, you're going to see it on your profile. Now, if I keep that card open for another 2 years, 24 months, now month 25, that's going to run off the credit report. So that negative late payment I was there, it's going to completely disappear from my credit history on my credit report, again, impacting positively my score. So no quick fixes. Can you fix my credit? Certainly you can. You guys might hear of things like Lexington Laws, very popular out there. You might see signs that say we repair credit, right? Some of these places work just fine, but there's a cost associated to those. I want to pay attention to Fair Credit Reporting Act, and that is a process and an act that came in place to protect consumers. So simply, it's called a dispute process, and you can challenge any piece of information that you feel it's inaccurate or that you feel that you shouldn't be having to pay back. So you can dispute the negative information that's sitting in your credit report. And some credit dispute forms look like this, where you're asking them to validate the information. It is not up to you as the consumer to validate, but you're requesting through the credit bureaus these financing providers or service providers to validate certain pieces of information. And they need to verify 5 points that they've tried to collect, that they have updated information, last time that you missed a payment, etc. And if they can't validate those points, then that gets removed from your credit report. So that's pretty much what Lexington Law and these credit repair agencies do, which again comes at a cost. Okay, and think about when you're building or rebuilding credit, you might spend some money eliminating negative credit history, but it's going to cost you to also establish positive credit, and then it's also going to cost you on your down payment and so forth. Okay. And then, with that, there's additional tools that you guys can take advantage of. And then this now kind of takes us to kind of what we're all waiting for, right? So it's got the home ownership piece. And again, this is a guide that I'll send out, kind of as check boxes that we all can use when it comes to kind of initiating that home ownership process. Okay. So, number one, kudos to you guys getting educated on here. We'll talk through a few of these. So we'll dive right into that component here. So getting pre-approved. What is it that most lenders are looking for? Okay. They're looking at a minimum score of 600 to qualify through FHA. In some cases, there are programs that fall into the 580 category as well, right? But as I talk to customers, I say, look, we should be shooting for a 640 score. Why is that? The 640 score allows us to qualify now for more types of programs and even down payment assistance resources that might be out there through city, county, state programs that are out there. So again, you have kind of these 600 for an FHA, 620 conventional, and then a 640 in order to now qualify for more sorts of programs that are out there. I mentioned the credit history component, right? And this all kind of falling into place here. Even on the collections component, medical bills are taken into account. They don't want to see more than $500 of medical bills sitting on your collections in your credit report. So it is important to either settle or pay those down so that there's no outstanding negative history. I also mentioned the benefit of a dispute process could help you eliminate negative history, but you got to make sure that as you're moving into a pre-approval process, that there's no active disputes happening on there. Okay. You also want to make sure that you have 2 years of income history by filing your taxes, okay, with no gaps, and then same field or same type of payment. And the big deal is kind of somebody moving from being a hourly or salary worker, now moving into a full commission type of job. It doesn't guarantee the same type of income on an annual basis to meet the requirements, right? And then lastly, the assets component, and that's where we got to make sure we have our ducks in a row, our savings account, our 403B statements, etc. And while you might not be inclined or need to use the funds in your 403B, they're certainly used for verification purpose of assets. So certainly make sure that you contribute to your 403B, as you can always leverage it for multiple purposes, okay? Whether it was an emergency, again, or for big ticket item purchases and striking while the iron is hot, okay? So make sure that you take advantage of all of those out there. Here's kind of a form that we can send out as a follow-up, kind of a purchase checklist that can help you guys kind of stay in line with those pieces, okay? Then I'll cover what are the most common types of loans. You have a FHA loan, Federal Housing Assistance loan, minimum score of 600. And then, it says maximum financing, 96.5%. It just means that you only need to come up with 3.5% down, okay? Minimum down payment, 3.5% down. The big difference between a conventional and an FHA, it's the FHA's federal guaranteed type of loan, which requires any buyer to include the mortgage, mortgage insurance, the PMI they call it, on the loan, and it needs to stay for all 30 years unless you refinance. And there's costs associated with refinancing. If you can afford to save a little bit more money for your down payment, again, but most likely a conventional loan is somewhere around the 5% marker, 3 to 5% in most cases, okay? But as soon as you earn or build 20% equity into your home, you can simply do like your bank might do an assessment or reevaluation on the property, and the PMI can be removed. And the PMI, it's not a mortgage insurance that has value to you as a consumer. It's pretty much a protection of a loan in case of a default, protecting the lender. Okay, so it adds no value to you as a consumer, and that could be $80 to $200 a month. Okay, so FHA, lowest entry costs into a mortgage, okay? But there are some added costs on a monthly basis with PMI, etc. On a conventional loan, a little bit more money on the entry point, but again, it could have some benefits as you can remove some added costs throughout the life of the loan. All right, and then this is an example of kind of what that would look like. On a kind of round number purchase price of 100,000, we see the 3.5 versus the 5% down payments. We see them on there, right? Closing costs, it's a component that we might not hear a lot about, but typically somewhere around 4% of the purchase price of the home. So think about it, right? If it's 100,000, it's close to 4,000. If it's 200,000, potentially it could be somewhere between $6,000 to $8,000 that you might have to come up with, right? So in these particular scenarios, you look at again the lower entry cost. That's why most or a lot of folks, look to the FHA component. So it's a lower entry cost when it comes to the homeownership piece. Okay. Then here, as we talked earlier about budgeting, potentially lowering monthly payments on a monthly basis related to credit. The big qualifier for a home is called the debt to income ratio. Okay, pretty much you take your annual income, pre-tax gross income, before taxes income. Okay, so if it's 50, 60, 70, 80, you take that number and then you divide it by 12, and then it's going to give you a kind of monthly budget that you're going to have for to be able to qualify for that home or your income. And then the 45%, it's the highest ratio that a bank might feel comfortable lending at. So from your monthly income, so take your 50,000 divided by 12 gives you a roundabout number. Multiply that by 45, and that's going to give you your mortgage payment number that you could qualify for. Okay. Now in this scenario, from the 2,500, this person has an allotment of about 1,125 to be able to use all of that 1,125 for a mortgage payment. Okay. And here you see on the left-hand side what makes up that mortgage payment. And that could vary, including homeowners association, etc. Okay. But in this scenario, from the 1,125, now there's a monthly payment to a loan of about $300, which could very well be a vehicle, a car loan, right? So from that 1,125, we're going to deduct the 300 because they're already compromised for some sort of other credit debt. And then we also have $25, which could be a minimum payment to a credit card. So we're going to take that out. So when they were qualifying for 1,125 mortgage payment, now at this point, because of the outstanding debt that are out there, now this is your budget to be able to qualify for a mortgage. So again, they could have qualified for a bit of a better property, higher sales price, but because of that outstanding monthly payments reporting to credit, they can only qualify for an $800 mortgage. All right. And we can go over any questions around that component there as we're getting just to our end of the presentation here, everybody. Again, down payment assistance programs. The two biggest challenges around purchasing a home: credit and down payment. And we simply want to create awareness that, there are a number of programs out there, the city, state, county, and then also banks, different banks or lenders might have programs. I'm happy to say that Fifth Third Bank does have a down payment assistance program. It's based on the geographic location and the median income of the property. So there's kind of two qualifiers for that down payment assistance. Here in the Palm Beach County, the University of Florida Extension Office, we do seminars with them. They are one of those organizations that you can take their 8-hour responsible home ownership course. And they give you a certificate that now allows you to qualify for the different types of down payment assistance programs. It just shows that you're a serious consumer. You've educated yourself on the different types of programs and processes, and you can move forward with kind of the down payment assistance program that are out there. But I say to folks, as great as these programs are, the reality, the unfortunate reality currently is that, it is, call it a seller's market, right? So I say we should be setting ourselves up to potentially buy without the assistance programs that are out there, simply because as a seller or in the industry, a purchase done with down payment assistance takes twice as long as a purchase without down payment assistance. So if I'm a seller, let's say if you are a seller, would you want your sale to happen in 30 days, or would you with your sale happening in 60 to 90 days, especially if you're needing to either buy another home, etc. So be mindful of that component. They are out there. What I mentioned does happen. It is happening a lot in today's environment, but it should not deter you from prepping to take advantage of all of those resources out there. I want, our teams, and our customers to be educated buyers, so that they can have the biggest advantage when they're going out into the marketplace out there. And at this point, I'll pause as I've concluded a lot of the content when it comes to the home ownership piece. And I know I have a couple of my partners as well. I believe I have Miss Fran out here, Miss Alicia Keller as well, who are our trusted advisors at Fifth Third Bank and add tremendous value one-on-one to our customers. And again, at this point, I'll pause so that we can open up for any questions, comments, on thoughts around some of the content that we went over today.